What's up guys, Jake here. In this video, we're going to continue talking about trading options and cover an advanced trading strategy. And when you finally learn more about trading options, then you might want to consider a credit spread. There are two kinds that we're going to cover in this video. There is the bear call spread and the bull put spread. We're going to explain them and then do some examples. And before you can do this, of course, with your broker, you have to get approved for vertical spreads. This is Charles Schwab, my broker, so I need to be approved for level 2. So make sure that you're capable of trading vertical spreads. And definitely, this is not an intro video, guys. If you don't have a firm grasp and confidence in selling covered calls and selling cash secured puts, this video is not for you. Go watch those videos first. I have a playlist on trading options with 27 videos so far. So there's lots of examples for you to better familiarize yourself with selling covered calls and selling cash secured puts before you try vertical spreads. But why would you want to sell credit spreads? And it's the same reason you would want to sell covered calls or sell cash secured puts. It's to collect that premium. You're the seller, net seller in this exchange, and you're taking advantage of theta decay of options contracts. So the best time period to sell credit spreads is in, that 1 week to 2 month time period where the theta decay of an options contract really starts accelerating. And credit spreads have two legs. First, you're going to sell an option, either a call or a put, because you want to collect that premium. However, you don't want to tie up collateral, a huge amount, like you do with a cash secured put or a covered call. So you're going to buy another option for a premium, but it's going to be a lesser cost to you, and it's going to have a further strike price with the same expiration. So your profit on this credit spread is the difference between these two contracts. And the collateral tied up on this trade is much lower than 100 shares of whatever stock or ETF you're trading on. So specifically, the two kinds of credit spreads are the call credit spread, sometimes called a bear call spread. And this is where you sell a call option and then buy a call option with a higher strike price, same expiration date. The other one is the put credit spread, aka the bull put spread, where you sell a put option and then buy a lower strike put option with the same expiration date. Let's get into examples. So first, let's talk about the call credit spread, and this is when you're bearish on a stock. You think it's going to go down over the next 1 week to 2 months. So you're going to sell a call. Now, normally, if you're selling a covered call, you have to own 100 shares of the stock. But we don't want to do that. And if you just sell a call, then this is a naked call. This is very high risk. Your broker doesn't allow this because your losses are uncapped, theoretically. If the share price moves on you and you're negative and it just keeps going up, once again, your losses are unlimited. So what you do to protect yourself is to limit your losses by buying a call. So you sell a call for a strike price, you then buy a call for a higher strike price. This in effect covers you and caps your losses on your call. So once again, let's assume that you're wrong. You're wrong on this entire trade and the share price of the stock blasts through the call you sold, but then hits the call that you bought. The call that you bought is now gaining value at the exact same rate by expiration that the call that you sold is losing you. So in effect, these two cancel out. So what is your max loss on a call credit spread if you're wrong? And if you're wrong, it's just the difference between these two strike prices. This sweet spot here, when all extrinsic value is converted to 100% intrinsic value, this is the most collateral that you can lose and the only amount of collateral that your broker requires you to be tied up. But as long as the share price of the stock stays below what you sold a call at, if it just goes sideways or down, then you're going to be able to collect the premium. Yes, the call that you bought will expire worthless, but so will the call that you sell, allowing you to keep the premium minus what you paid for the call that you bought. Let's do an example with my broker Charles Schwab on the stock Apple. Apple has had a huge run up lately. It hit 149, and let's pretend that you're saying Apple was overbought. It's run up too much in the short term. I think over the next month it won't get back to 149. It will stay below 149. Now, in my brokerage account, how you do this is on the right, there's a drop-down menu. This will take me to the option chain. And if we go to Apple's option chain, first thing you have to do is choose an expiration date. I'm going to go roughly 1 month in the future. And we have to choose a strike price. And just looking at the graph, I said, well, 149 looked like it was overbought. I don't think it's going to get back to 149 in the next month. Now, to sell a covered call on Apple with a strike price of 149, I have to buy 100 shares. I need $14,200 worth of collateral locked up. In addition, if I think Apple's share price is going down, why would I want to be holding 100 shares of it? So a credit spread protects you from having to tie up that much collateral and hold a stock that you think is going down anyways. So let's figure out what range we want to do our spread with. So if you go to custom range, let's do strike prices between 142 and 160. Additionally, I just want to reference the Greeks to quickly check delta. So on Schwab, you can go to this drop-down menu and then hit Greeks. And this is actually great because the strike price of 149 has a delta value of about 30%. 30% is what I usually do anyways, and I wanted that 149 strike because there's a resistance line. That's where sellers stepped in. It wasn't able to get above that. Now, we have to determine how wide we want our credit spread to be. So I'm going to choose the call that I'm buying with a strike price of 152. So let's recap here. I'm selling a call with a strike price of 149, and I'm buying a call with a strike price of 152.50. So when you select these two, your broker should build you the chain, and you have to, under action, correctly select sell to open for the call with the lower strike, and then buy to open the call with the higher strike. Your broker that will then just calculate for you based on the bid and ask what credit you will be receiving, and I will be receiving a credit of $78. $78, is that a good credit for a 1 month call spread? Well, let's do the math here. And the collateral you're tying up for this trade, your broker is going to set aside this buying power, is $350. So the difference between 152.50 and 149 is $3.50 multiplied by 100. So your broker is going to tie up $350 worth of buying power. Now, what is your max loss on this trade? And if the share price of Apple blows past 149, goes above 152, 350 is your max loss from the trade, but you got to remember, you're getting paid today a credit for doing this spread of $78. So your max loss is 350 minus 78, only $272. That's not that bad. So if the max you can make 78, if all these contracts expire worthless by August 20th or something, your max profit is 78, your max loss is 272. Now, you might be saying, Jake, $78 for a month? That's not doing all this effort and work for just $78? Well, what people do with credit spreads is they sell multiples of them. So let's say that you find a trade that you really like and you have a high confidence level in. You can change these quantities to whatever number you want. You can up these to 10. And if you up it to 10, then your collateral that you're locking up is just 350 times 10, so $3,500. And then what is your max profit? Well, it's 78 times 10. You can make $780 in a month. So what kind of return on investment are you getting here? And your return on investment is $78, your max profit if you do successfully do this trade, and the collateral you tied up, $350. So the most you can make on your money in a 1 month period is 22%. 22% is pretty good. The equivalent APY on this vertical spread is 267%. Now at this point you might be wondering, why is this so much better than covered calls? And the reason why is because you're not locking up the full collateral. To sell a covered call, the little bit more premium you're getting, so for example, $227. For a true covered call, you have to lock up the full premium of 100 shares, 14,000, to only make 227. But this way, you're only locking up 350 to make the credit of 78, a much better return on your capital. So that was a bear call spread. Now let's look at a bull put spread, which is the opposite. So instead of selling a cash secured put, you want to sell a bull put spread. So in this scenario, you think that the stock price is going to continue going up, and you're going to sell a put probably just below where the current share price is. And if you're wrong, you're going to be in trouble. This would be a naked put that you just sold. So your losses are not unlimited, but it's basically the entire value of the stock price if the company were to go bankrupt and the share price were to go to zero. So to protect yourself, you have to buy a put with a lower strike price, same expiration date. So just like the other example, your losses are now capped. If you're completely wrong on this trade and the share price goes down below the put that you sold and also down below the put that you bought, the money that you're making in intrinsic value from the put you bought is canceling out what you're losing from the put that you sold. So this caps your loss at this line. So as long as the share price of the stock trades sideways or goes up, then you will make money on this exchange. The put that you bought will expire worthless out of the money, and the put that you sold will expire worthless out of the money, allowing you to keep the premium. So once again, let's do an example with Apple, and we'll say, no way, Apple's an amazing company. This pullback to 142 is temporary. It's going to shoot back up next week, or for sure within the next month. So once again, you can look at a chart and see it two different ways. So let's choose a strike price of 135, and you'll say there's no way that Apple's share price is going to get below 135. So let's go with an expiration date of August 20th and a strike price of 135. And when you go to the expiration date, August 20th, custom range, I chose between 130 and 141. We're going to choose the strike of 135 for the put that we're selling, and then 130 for the put that we're buying. And when you plug these in, buy to open for the 130, sell to open for the 135, it's going to calculate our credit. So let's run the numbers again and see how much we're tying up and how much we're making on our money. And the collateral that we're locking up, once again, is the difference between the two strike prices. So $5 per share, $500 total. The credit we're receiving, it's quoting us at $1 times 100, $100. So our max loss is $400 on this trade. Our max profit, if we're correct, and Apple's share price only goes down a little bit, goes sideways or goes up, is $100. So our return on our investment over this 1 month period is 20%. That's the equivalent APY of 240%. And once again, if you're just not impressed with a credit of $1, you could change these quantities to 10. That would lock up $5,000 in collateral, and you could potentially make $1,000 over the next month with just a bear put spread on Apple. Okay guys, I hope that summarized credit spreads. The last thing I want to tell you is to sell everything. Always with your contracts, buy to close them, sell to close them on the expiration date, before the expiration date. The reason why is when you hear these stories of people blowing up their accounts and their Robinhood account shows an account balance of negative $700,000, that's because they were getting in trouble selling credit spreads, quantity, something like 50 on Amazon, and then one leg of their spread was exercised and something weird happened after hours on Friday where the other leg, the share price moved and the other leg doesn't get exercised. So to just avoid any murkiness or confusion when these contracts are moving between the brokerage firms, buy to close, sell to close. Don't hold these until expiration unless it's really obvious that all the contracts are way out of the money. There's no way after closing bell on Friday that they could potentially end up in the money. Okay guys, if you enjoyed this video, give me a thumbs up so the algorithm knows it's good. In addition, if you have any comments or questions, leave them down below. I'll help you if I can. Till the next video, take care.